Hello everyone, welcome back to my channel. So this video marks the end of the week number 74 in this Road to 100k Realized Return Challenge. And first of all, I hope you guys had a very good Christmas for those who follow this uh, tradition. And yeah, this has been a very short week, even shorter than usual when we have a holiday in between the week. Basically, we had just 3.5 days of trading, and those were pretty unremarkable, except for the only highlight of the week, which came on Monday, which was the GDP growth. This is, of course, a delayed report for the Q3 that showed that the US economy outperformed not only the previous quarter, which was 3.8, but even the median forecast of 3.2. And so the actual number came out 4.3%, which is at first glance a very good performance. Looking here, however, I took the time to look at this is the the the, um, the website of the Bureau of Economic Analysis, which releases this information. And even though, of course, as you can see here, there is an accelerating trend over this year, you can see here the actual contributions of for the GDP from all of its components. As you probably know, the GDP from the biggest or the most widely used uh, perspective of GDP is when you add the consumer spending with investment with the government expenditures and then the net balance of trade, which is basically exports minus imports. And as you can see here, consumer spending, of course, gave the biggest contribution. As when it comes to the US economy, consumer spending is about 65 to 70% of the entire GDP aggregate number. So this, unsurprisingly so, gave the biggest contribution. And not only that, some warning signs: investment went flat. And you can access this website and have a look as well. You'll see that investment came out relatively with no contribution, basically, and especially because of a decrease in inventories, which is understandable given the fact that most companies probably loaded up their inventories to front run the tariffs a few months ago. And now, because some of the tariffs were in fact realized, some of those did not. And so basically, yeah, companies decided, all right, let's offload this inventory before ordering anything else. And so this is probably what took place when it comes to the performance of the investments. Also, as well, you can see that exports also increased its contribution to GDP, and imports decreased. Again, this was probably as well because of the tariffs, or the threat of tariffs. And yeah, as you recall here on Q1, there was GDP had a very negative performance. It went below zero. It was negative because of the large increase in imports, which is, I assume, consumers and companies try to front run the tariffs by importing as much stuff as they could. And now that they don't need they can't they can, there's no need to front run anymore, because the tariffs that are put in place were meant to put in place already in place, and some of those didn't even come to fruition. So that's probably the reason why the imports now had decreased their contribution to GDP. And because they are a subtraction to the GDP, a lower contribution, that means it further boosts the GDP. So this is basically what came out. Even though it's a good number, but nonetheless there is some warning signs when it comes to the investment. All right, and yeah, basically the rest is offsetting what had previously happened. Um, other numbers that took place, yeah, durable goods orders also had a decrease, which is a sign that consumer confidence it must be quite low at the moment. They don't feel enough confidence to spend in goods which are more expensive, and they are of course more longer lasting, but they require more financial commitment because they don't know what is going to come next, what's in store for them in the next couple of months. And so this is probably the reason why durable goods orders came yeah, pretty worse than expected. Um, yeah, the rest is pretty much a non factor. Yeah, also as you can see, yeah, consumer confidence came lower than expected. This is probably also related to this lack of performance in the durable goods orders. On actually, I must make a correction. GDP was on Thursday, not on Monday. Yeah, and on Wednesday, which was a shortened trading session, only the jobless claims, which came below the expected number, but this didn't make much waves in the market. And then yeah, holiday the market was closed on Thursday because of Christmas, and on Friday there was nothing to report about. So yeah, basically this was a pretty much unremarkable week. And as as it turned out, this ended up as usual, being because it was holiday season. This usually has a positive effect on the market, and yeah, what transpired is that most all the major indexes, went up. In case of the Qs, which follow the Nasdaq, despite a little of a lull here, it ended up going pretty much upwards, and now we are about a little bit more than 1% of our cost basis of 630. Now the stock ended up last week at 623.20. Now at this moment, we are already with the calls that we sold which expired worthless. We are now with a cost basis of a little bit over 620, but we still want to get our $630 back, and so next week we are going to sell the calls against the 630 and see what happens. We managed to collect this week 358, almost $359, which is, yeah, it's a very low amount, but we only had 3.5 trading days, and this is holiday season. This is probably the best we could have hoped for. Next week we're gonna have probably a similar performance, because it's also a week with the holidays, with a holiday on January the 1st. So yeah, expect more of the same. But yeah, now we have our buying power left, because here the trades that we did, which you saw here on our scoreboard here, all the trades ended up expiring worthless. The calls we sold on the Qs, also the puts we sold on Nvidia, also the put that we sold on ARKK, and we managed then with the rest of the money that we had, we managed to also sell another put on the RKK with a 78 strike price. All of them expired, no further commitments. The puts and the calls simply expired worthless. So now it's rinse and repeat for next week. For next week, I believe we have nothing else in store as well. We have the minutes, which may tell a little bit more about what actually transpired in the meeting of December 18th of the Fed meeting. Probably it's going to tell again that there was some discourse between the members when it comes to either lower the interest rate or keeping it steady. But yeah, apparently this is not going to I believe this is not make much waves in terms of the market when it comes to our let's just say thermometer when it comes to the Fed fund futures for the potential direction of interest rates. This is where we stand at the moment. Less than 20% probability of a rate cut in the coming meeting, which is on January 28, precisely 1 month from now. But all the bets are on the rates keeping it steady, which is probably really what's going to happen. We had already 3 consecutive meetings with a rate cut. We don't know if probably the Fed may want to wait and see a little bit more what is the effect of these rate cuts, but yeah, we'll see. For the first few meetings of January, probably we'll have some. We will start earnings season again for the fourth quarter, which is of course as well for the entire year 2025. So that probably will move the market a lot. So expect some volatility in the first few weeks of January. But yeah, that's a topic for another video. For the time being, yes, this is all. I wish you a very, very good end of the year 2025, and of course a lot of success in 2026. But for the time being, yeah, this is all. Feel free to leave your comments in the comment section down below. I'm also available on LinkedIn in case you need to ask me any questions. And as always, feel free to like the video and subscribe to the channel. And we'll reconvene either on Monday evening or on Tuesday morning to start the week number 75 in this challenge. And I'll see you there.